something huge is happening with Lemonade. This gives the stock a ton of potential.
I have to say, I am so impressed with the potential you see in me. Yeah.
In this video, I'm going to dive in and show you what I mean. So on the menu for today, we're going to look at my churn update. Also going to look at some retention curves that I've ironed out a lot of the wrinkles in and a lot of the details for. And then we're going to look at the lifetime value per cohort and why it's going exponential. Possible lifetime value per cohort. You'll see what I mean. It's quite interesting. Stick around to the end of the video as I will be explaining what Lemonade needs to urgently do in 2023. What's their 2023 to-do list and why it's so important. So let's dive into it. First of all, I want to mention that I had a mistake in one of my last videos where I said that last quarter, Q3's customer churn was exceptionally high. And I had a couple people point out to me a potential flaw I had made. And here was the flaw. They were correct, which is really reassuring because it meant the churn was kind of the same or coming down. And the mistake I had made is when calculating the customer churn, I had used the premium per customer, which was $343, which was a major jump from $290 the quarter before. But the reason for that jump was that quite a few Metro Mile customers, about 100,000 customers, got added to the pool. So when they were calculating churn from 12 months prior, which Lemonade provides their annual dollar retention numbers for, these numbers were incorrect to use for that calculation. So instead of 343, I used, I think it was $302 as kind of an estimated, excluding Metro Mile customers, premium per customer. It might even be better than that, but we were at then the 28% churn, so similar to the last quarter. So really, really good to see that. And if you look at churn from previous last few quarters, since we can calculate it at least, we're at 40% back in 2020 beginning, and then slowly trended down into 30%, and now we are getting below, for the last two quarters, below 30% to 28%. So really good to see that trend, and I think we'll continue to see that trend occur as churn slowly goes down, down, down. It's also interesting, at Investor Day, somebody asked during the Q&A about the customer churn referencing my calculations, and Daniel kind of gave an answer suggesting that my calculations were a little bit too high. And then I also was speaking with some management after the event and also was told by someone there that my calculations were a little bit too high. And the only way my churn calculation could be off is because this premium per customer 2 value, I actually don't know exactly. I'm just estimating. See, if you look at the definition of the annual dollar retention, to calculate ADR, we first aggregate the in-force premium for all active customers at the beginning of a period and then aggregate the in-force premium from those same customers at the end of the period. So, at the end of, say, a 12-month period, we know the average premium per customer, which would include those old customers plus any new customers, but we don't actually know the premium per customer for the old customers. But so if my churn was a little bit off because I was just using the average overall book of business premium per customer value, the only reason it would be off would mean that for those old customers, their premium per customer was actually slightly less, which basically means that the new customers coming in the door tend to have a higher than average premium per customer, and the old customers that were there from 12 months prior, their premium per customer is likely rising as a certain number of those customers cross-sell to new products, but not rising as quickly as the overall book of business, which would then mean that would then lower my churn calculation slightly. So to account for this, I basically added in a 98% factor, or about a 2% difference to my churn, and added that across the board, which basically lowered my churn by about 2%. So it'd be at about 28% now instead of 30% or 31% in Q1 instead of 33%. Just a slight, I don't actually know the value, but I'm taking a slight guess on what it could be based on how the premium per customer has been growing each quarter and based on just the comments that I heard. By the way, this entire Lemonade model and the retention curves we're about to look at is available to my Patreon members. If you want to join my Patreon, I will link that. So now I want to look at a little more detail at the retention curves for each cohort of Lemonade customers. So on this other spreadsheet here, the way I've modeled and laid this out is I have some of the initial data, total customers, premium per customer, annual dollar retention, a quarterly annual dollar retention. I won't go into all the details here, but I laid out each potential customer cohort from 2018 Q3 all the way to the last quarter, Q3 of 2022. And for each one of these, so let's look at 2018 Q3, I calculated their customer retention quarter by quarter. So a quarter's away in time. 1 quarter after those customers existed, there were 91% of them left, and then 76%, and then 65, 58, 51. It goes on and on and on. Of course, the older the quarter, the more data we have. So all the way up to this blue line is where I start to make an assumption. Is where I'm just projecting where the retention might go. But we get to all the way to 17%, and then I've projected this out as a descending curve all the way down, something like 49 quarters away, so something like over 12 years into the future, where every single one of those customers in that cohort are now gone, have moved on, have died, have changed carriers, have churned in some way. So this sort of shows their retention. And I did that for every single customer cohort from 2018 Q3 all the way to this quarter, and then projecting them out through time. And if you look at just what was calculated, not was projected, you'll see that by 2018 Q3, here's your customer churn or customer retention in blue. It kind of descends and drops down. And then by a year later, 2019 Q3, your churn is also following that curve, but it's doing a little bit better. So that's a really positive sign. And then by 2020 Q3, again, doing a little bit better. And then by this would be 2021 right there, Q3, or again, we're starting to see that it's even higher above the other ones. And I expect this trend, as Lemonade rolls out more products in more places, has those bundling opportunities available, this trend will continue to rise, and these lines will continue to slope higher and higher and higher. And it is interesting to see sort of like after 8 quarters of time, so sort of 8 quarters into the future, we're at about 37% retention, but then after 1 year later, the next cohort a year later is 42%, so about a 5% increase. And again, about another year later, we're at about 46%, so another 5% increase. And this line right here looks like it could easily be another 5-6% higher. So each year, we're gaining maybe about 5-6% sort of overall retention to retention curve, if that makes sense. While these curves might look kind of bad, like, wow, it's really diving down deep, it's actually very encouraging for me to see that the trend is continuing upward and onward, upwards and onwards, and I expect this trend again will continue to rise. But then I went beyond this. See, what we're looking at there was just the white values that went up to the blue projected values. I then took those curves and projected them out all the way into the future. So if we look at that customer retention with projections, I put a few quarters on here, 2018 Q3, and then a bunch of Q2, so we could kind of line it up with the most recent quarter. So some of these, of course, it's a lot of assumptions here, but where these curves could go, but I just projected them out into the future. The blue line being the one with the most data possible. We had about 16 quarters of actual data, line ends around there, and then I just projected it all the way down to about 0 as you get out to, the 60 quarter range. So after about 15 years, you're saying, yeah, a lot of these cohorts, most of the customers are going to be gone. Again, I projected that forward for each one of these quarters following a similar trend line, but sort of an improving trend line with time, which is kind of what you would expect to happen. And then I took this one step further and I thought, you know what? We could actually calculate estimated lifetime values for each cohort of customers from these graphs. Because if you think about it, say this is one graph for a Q3 2018 customer, and it kind of follows this trend all the way down, and there's maybe, whatever it is, maybe there's 100,000 customers in that whole cohort. They're slowly descending, slowly churning away, and only so much is left. But as you go forward in time, also their sort of average premium per customer is continuing to rise, because a lot of those customers are going to cross-sell, they're going to get older, they're going to buy multiple products. So maybe the 1% here is no longer paying $5 a month or $20, $30 a month average, but is now paying maybe $500, $600 a month average, right? So your premiums are rising along there, but also, so what I did is I imagined that each cohort, if you take the area under the curve, it kind of gets you a total customer basis. How many quarters of how many customers, sort of unit customers in each cohort are applicable or are still paying customers. So if you take the area under the curve of each retention curve, and then you multiply that by the average premium per customer across that distribution. Of course, it's rising from 0 all the way out to 0, all the way until the curve reaches 0. Your premium per customer is rising. So if you multiply that by your premium per customer, and then you take about a 24% average as your conversion of gross earned premium per quarter from in-force premium per quarter, then you can get kind of the total premium per customer cohort for their entire lifetime. And then Lemonade has been so gracious that they've actually released some expected lifetime loss ratios per cohort. So this is kind of the expected average loss ratio for each cohort. So they've given us a number of values. They gave them in the Q2 2022 letter. They gave some values, and then also the same overlapping values that I was pointing out in this post are actually changed very little, which is a good sign. So 1 minus this multiplied by the total premium, gross earned premium per cohort, would get you kind of the expected lifetime value per cohort. And that's what I did. So I went through here, each one of these quarters, I calculated out, okay, in this one we have so much retention, and we have so much premium per customer, and there's a certain amount of gross earned premium converting from in-force premium, gets you a total amount of gross earned premium per cohort in that quarter. And then I did that all the way through until there's nothing left, all the way out into the future there. I did that for every single quarter, every single cohort's life. And you have all those values. You then sum up all those values, and you get a total gross earned premium per customer for each cohort's sort of unit customer. And you can see that value is growing significantly over time. From back in 2018, we're about $400 and some per customer, all the way rising all the way up to around $2,000 per customer right now. I don't have all of this laid out because it's a little bit tricky to know what the average loss ratio for each cohort would be. So I just plugged in 85% for a number from 2018 to the end of 2020. But then starting in 2021, just like I was showing in that one tweet, Lemonade actually has that value given. So I have that laid out. Your average loss ratio ranging from 86% descending all the way down to 61%. Now, again, these are just projections. We don't know if this will actually come true, but this is what Lemonade is thinking and projecting. From that, you can then calculate the lifetime value, as I was saying, of each cohort. This is where it gets really, really interesting, because if you look back at just the start of 2021, we're only at $168. And now we're at over $800 per cohort. And let's just look at a graph of this to make it a lot more visual. So a lot of these cohorts are kind of linearly moving because I just had an 84% expected lifetime loss ratio. But then in the last few quarters, where they've actually given us data from the start of 2021 till now, you can see just a massive shift in the expected lifetime value of each cohort. So this cohort right here, 2021 Q1, they're expecting only $168 of lifetime value, or at least what I'm calculating and based on the assumptions I make. Pretty piddly when you consider they may have spent even that or more on marketing just to acquire those customers. But this steadily rises from 200 to 300, 364, and then a huge jump, 542, 597, now jumping again to $807. Huge shift. And if we look at the lifetime value divided by, I took an average customer acquisition cost of $186 per customer, looking at some average data across there. We then take a ratio of lifetime value divided by the CAC, or the customer acquisition cost. You can then see from the start of 2021, we were actually below 1, so not good at all, but now we are above 4. So somewhere in that 3 to 4 range. And that's a figure that I have heard Lemonade cite in the recent past, even before Investor Day. And I think that figure will continue to move higher, as I'm kind of showing that might even be above 4 potentially for the newest customers that are coming in the door. And this is where it gets really exciting, because if you have customer retention rates slowly improving, steadily improving, because your churn is getting better and better, so your customer retention is getting better and better. So if you have customer retention getting really better and better, marching along, improving, and you have premium per customer steadily improving, slowly growing premium per customer, those two things plus the loss ratio, if that can actually keep descending. So your average loss ratio for each cohort, if these numbers are anywhere close to reality and they get better and better, slowly improving down into the 60% range, even 70%, 60 some percent, you're going to have, the result is your lifetime value is going to explode. And it is exploding up from just, a few quarters ago, we're at $304, start of last year, $168, now up to over $800, and your LTV to CAC ratio going from just barely over 1, like a 1.9 to 2.9, all the way up to exploding, jumping somewhere probably above the 4 range for the most recent quarter. Super exciting, and an exponential movement, because you have this combination of the retention is improving, your premium per customer is rising, and your loss ratios are also rising. So when all three of those things are rising, you can have this exponential move up. And this could move potentially even higher before sort of forming an S curve. Of course, there's a lot of assumptions here. We have to assume that the loss ratio will continue to improve, and that these loss ratio numbers they are giving or expecting are anywhere close to reality. Of course, there's lots of assumptions behind this this trend continuing to rise up and off the page. First of all, we have to assume that the loss ratio is going to, that they are giving us, these average lifetime loss ratios, are anywhere close to reality. So if they're not, we're going to have problems. If this is 95% actually for this entire cohort, you're not going to have a LTV to CAC ratio of over 4. It's going to be very, very bad ratio instead. There's a lot of reasons why, what I covered in the last video, why we could expect the loss ratio would improve. But that is a major risk and a major assumption behind what we're seeing here. Another assumption, of course, we're making is we have to assume that this retention rate that is improving year over year continues to improve year over year. But I think that is a safe assumption. I think that will steadily improve and just march onwards better and better as Lemonade rolls out more products in more places. And as they roll out, and then the third assumption is you have to assume that their premium per customer continues to rise. And I think that is also a slam dunk. If they roll out more products in more places, you're going to have more bundling for more customers, and your premium per customer will continue to rise steadily into the future. So the biggest question mark maybe is the loss ratio, but if that can descend, which I think it could as well, along with the other two assumptions we just talked about, then you could have this exponential move continuing to grow, where your lifetime value continues to rocket up. So while this is all very exciting, there is an urgent to-do list for 2023 for Lemonade. And here's what it is. They have to get regulators to approve price changes. They talked about Investor Day. Some of their states, especially California, the regulators have caused a lot of problems where their products are underpriced, and they're running into a lot of problems. So they have to get regulators to approve price changes ASAP. They also have to combine Metromile Car product into Lemonade Car. Have to combine Metromile Car product into Lemonade Car, make it one seamless product, and then roll out that car product into all the main states they can. Roll that out so it's available to customers to have. And then they need to cut operating costs as much as possible. I've talked about this in other tweets and other videos where I feel they could cut back on some of their operating costs. They need to do that so they can use those funds to further propel growth as much as they can. If they do all these things, that chart we're seeing, that lifetime value of each customer cohort, I think will continue to rise, and I will be tracking that over time. But of course, that will rise because this will help improve their churn, their cross-selling between customers, their loss ratio will also improve if they fix their pricing, and their operating leverage. So overall, it's going to greatly push them towards profitability, and we'll of course see that in coming quarters as their expected lifetime value continues to rise and their lifetime value per CAC ratio will continue to get better. Again, if you want to see this entire model and my Lemonade projection model, make sure to join my Patreon. And also really helps me support the channel and helps me make more content and go even deeper into Lemonade so we can know for sure with more and more certainty, will they succeed or will they fail? Could they be a 100x investment or will they go to zero? So really important questions here that we're looking at. Thank you so much for looking at all these details with me. Let me know in the comments down below what you thought of this. I read all your comments. I really appreciate that feedback. You can find me on Twitter at PaperBagInvest. And remember, it's in the bag.